I'm making this video because a lot of people don't seem to understand what's going on in the credit markets, how it evolved, and what the biggest problems are. But also because a lot of people don't seem to understand that voting for John McCain is voting for a continuation of these same policies. This is a man who is heavily for deregulation, and his chief economic advisor was Phil Gramm, the man who actually created this entire mess. And I'll be happy to explain that along the way. This isn't a hit piece on John McCain. It's just the facts. It doesn't take any great mind to work these things out. And I'll show you, going right from Ayn Rand all the way to AIG, what has happened and why you certainly should not vote for John McCain. If you want to vote for somebody besides Obama, vote for Ron Paul or anyone else, Mickey Mouse, Donald Duck, but do not vote for John McCain. This is an explanation of how this happened, why it happened, and why Phil Gramm is responsible. And Phil Gramm, until just recently, was the chief advisor for John McCain. He's only been dropped because of this whole mess that he created. If you know of anyone who's thinking of voting for John McCain still after this horrible mess, please send this video to them. It comes in two parts. I call it the creation of monsters because that's what it is. The painting was originally done by Salvador Dali in 1933, post the first economic collapse of the United States in 1929. The first part we'll discuss is Ayn Rand and how she's directly responsible for a lot of what's gone on. Her idea, objectivism, is every bit as viable a thought process as is capitalism and communism, but most people don't know anything about it. Adam Smith helped found capitalism in its present form, Karl Marx, communism in its past form, and Ayn Rand, objectivism, which is basically capitalism gone rampant, and you see the results of that. The whole process starts with a woman with the name of Ayn Rand, a Russian emigre, who's a playwright, screenwriter, novelist, and also a pseudo-philosopher. People would like to think that she's a philosopher, but all she came up with was a system called objectivism, which essentially is runaway capitalism with no checks. Many of the people in our government follow her mantra as though it were from God, and one of them is Alan Greenspan. Therein lies the problem, and he is not alone. Chris Cox, who's head of the SEC, also believes that she had the right road. Understanding Ayn Rand is key to interpreting Greenspan. Rand espoused a radical philosophy of individualism and self-interest. She had a dislike for religion and compulsory charity, which she believed fostered resentment of individual success. She created a doctrine of rational hedonism, supported by unfettered capitalism and the rights of successful individuals at the expense of the community. She taught charity is not a virtue. She believed in the elimination of most state regulation except for crime control and the judiciary. In, quote, capitalism, the unknown ideal, unquote, Rand uses the word altruist to describe forces of evil that burden the beleaguered American business community. Greenspan, after earning his MA in 1950, became a 20-year associate of Ayn Rand, author of books like The Virtue of Selfishness, Atlas Shrugged, Fountainhead, and more. Greenspan wrote for Rand's newsletter and authored chapters for her books. The way things have progressed in the last 25 years almost would lead one to believe in intelligent design, but not so much intelligent design by God, but more Satan, because all of these pieces were necessary to make what's happened to our economy happen. It starts, I believe, with Fair Isaac, or FICO. There's no inherent problem with FICO. It was designed to help people get loans equitably, but the way it's been used is a problem. In the 70s and early 80s, the granting of credit was quite often a very subjective thing. You went to the bank, demonstrated you could afford a loan for a house, and they either granted it partly on your payment history, partly on your capital reserves, and partly on a gut feeling. Of course, this led to some abuse for racial minorities. So, Fair Isaacs came about. The founders had derived a very complex algorithm to predict what the prospect of repayment was. It sounds good, and if it had not been abused, it might have been. But as things matured, it allowed aggressive marketing of loans. The first act to set us on the road to ruination was authored by Phil Gramm, a man of immense talent at getting what he wants passed in the Senate, and he did so for his own benefit. It was the Gramm-Leach-Bliley Act. That was 1999, and the bill passed with a veto-proof Republican majority. In essence, the bill removed the restriction on banks and brokerage houses operating as one, which had been a major problem in the collapse of Wall Street in 1929. Many economists stated that while in a world regulated by the gold standard, 100% reserve banking, and no FDIC deposit insurance, the Financial Service Modernization Act would have made perfect sense as a legitimate act of deregulation. But it wasn't that way. Under the current monetary system, it amounts to corporate welfare for financial institutions and a moral hazard that will make every taxpayer pay dearly. This was said in 1999, but nobody paid any attention. In the year 2000, Phil Gramm got another bill passed, but he cleverly attached to the omnibus spending bill on December 15th. It was 262 pages long. Most people did not read through it. They didn't know what it was really about. They should have, but they didn't. And it completely dysregulated the CDS market, the credit default swaps market. This may sound like nothing to you. It's led to one of the biggest problems of this financial crisis. These instruments are like insurance policies. They guarantee that if a bond defaults, the owner will be paid. So, with his two acts and everything else conjoining at once, it was time for thievery. So let's trace the subprime loan mess from beginning to end. It used to be when you wanted to get a home loan, you went to the bank. Let's say, just for round numbers' sake, you wanted to buy a $100,000 house. The bank would have wanted to see about $25,000 in the bank. $20,000 for a down payment, that is, and $5,000 left over to cushion against bad times, like you're losing your job or getting sick. They would look at a credit report, meet with you, and make a decision. And the person that made the decision was responsible for it. If you didn't make the payments, they'd come back to him and say, "Why did you approve this loan?" Then came FICO. Well, all that changes. Clever people see a way to be just packagers, and they put together the loans and they shipped them off to somebody else. Many of those companies now are bankrupt. They had no liability. They just went bankrupt. They didn't have bank officers trained in risk management. They had processors trained to make loans. They didn't have to think. The market, post-Gramm, was hot. They checked your FICO score and your pulse. If you had both, you got a loan. Probably for $100,000 for your $100,000 house. No money down. They reap millions in loan processing.